Once again, ladies and gentlemen, boys and girls, and children of all ages, you're now tuned into the Investor Show. As always, this is your gracious host, the Prince of Investing, Prentice Dykes, coming to you guys and girls live all the way from the beautiful city and state of Denver, Colorado. If you haven't done so already, please go ahead and make sure you hit the like, subscribe, comment, and share button. And as always, I don't have a lot of time, and I definitely know you guys and girls don't have a lot of time, so we're going to jump straight into it. So as y'all can see in the description box title, or however you get this today, or if you hear me over your airwaves, we have a very, very special guest in the building today. You know, I always told you, I always do what's important, not what's popular, right? So something that people don't talk about, you don't see a lot, is the alternative markets, private markets. What is the private markets? What is the alternative markets? This private equity, private infrastructure, private real estate stuff, things that y'all saw me kind of go off the deep end some time ago. But today, I have a very, very special guest in the room today, from Threefold, not Triplefold.
That's right.
Right?
That's right.
It's a fund, an alternative market fund. It's not private equity. It's alternative market. What is this? What is this thing talking about? I want to expose you guys and girls who don't know about this or haven't heard about this. And if you had heard about this, tune in. You might pick up some or gem or two new. But without further ado, let me introduce my guest today, Mr. Daniel Perez and Mr. Vincent Hayes.
Great to be
Threefold Strategies.
Yes, Threefold Strategies
Threefold
Fund.
Strategies
yes,
Fund.
that is the fund. Yes,
And
yes,
you guys are out of Boston.
Boston
and Chicago.
And Chicago.
Boston, Chicago,
Yes.
and they're in here today.
Yes.
Stopping through in Denver after we just, I don't want to say what happened today because I've been undated my episode, so I don't want to date it. So anyway, thank y'all for being here.
Yes.
And first off, let me ask, Daniel, tell us a little bit about yourself. How you doing today?
Doing well. So I've been co-founder of Threefold Strategies Fund along with Vince, and I grew up in New York, outside of New York City. All my grandparents are immigrants from Spain, and they came over through Ellis Island, with no money, and then that set the stage for my father to have a steel business, and we went from there.
Okay.
I can tell you more about how we started the fund.
I want to get to Vince. Tell us a little bit about yourself, Vince.
Okay. Yeah. So, Vince Hayes, I'm also the co-founder of Threefold Strategies Fund. My story goes back to my great-great-grandfather. He was a slave in this country. He was dropped off in Virginia, moved down to Nashville, and then down to Alabama, and then that's where they built our family. His son, my great-grandfather, ended up, being able to secure a big chunk of land down in Alabama during the Reconstruction era, and we had over a couple hundred acres at the time. This is back in the early 1900s, and much of that land is still in our possession to this day as a family. So, 5 generations later, from slavery to where I am now, being a co-founder of a hedge fund, it makes my family proud. It makes me proud to know that, hey, only in America, right?
Only in America. Don King make that very famous.
That's right.
Only in America.
Only in America.
Only in America. Now, the thing that I really love about this, Vince, when we met in Chicago last year, right, at IDAC.
That's right.
Sitting down talking to you and hearing about the alternative markets, right? See, now you're seeing it. I've kind of noticed probably about the last 5 years, maybe decades, you're seeing more minorities, blacks, get into the markets. People are talking about it, and the markets become more accessible. This is my dad told me. The market wasn't a public market, wasn't accessible to you. You needed a stockbroker. You had to go to some big city. You had to have a certain amount of money, and you had to put in a certain amount of money. Then when you did do that, how did you keep up with the market? How did people keep it? You had to be subscribed to the Wall Street Journal.
High barrier. High barrier
It
to
was a
entry.
pretty high barrier. Now the barrier is coming down.
Yeah.
Information, technology has increased the accessibility. The conversation is starting to be had and things like that, right? Which is great. Now, underneath the public market, we have a private market, right? And then, we have, secondaries, then you have alternatives. And this is where you guys come in at a hedge fund, right? And I want to show more and more, with black males, you're always shown that you got to be an entertainer, right? Hey, if you can't play basketball or if you can't entertain of some sort, you have no value, right?
Yep.
So that's not true. There's other industries out there.
That's right.
There's other things you can do. You don't have to be an entertainer per se.
Right.
You can go into a hedge fund.
Right.
Right.
And I can tell you could be just as successful financially by going into the fight. You know,
Go ahead and tell us this.
Yeah,
How
I'll
much
just
money?
tell you.
Tell us the money.
I'll
Tell
tell
us
you.
the
I'll tell you.
money.
No, look. So, you know, we have our fund. Our fund has millions of dollars in assets under management, and we are an emerging manager. But this is the alternative markets, hedge fund markets, is a massive industry, right? We're talking billions and billions of dollars, right? So, if you are able to build up a business, you know, this is something that can be highly lucrative for you. And it doesn't have to be, you know, for us, for blacks, it doesn't have to be entertainment focused, right? It can be, you know, you're using your mind in this game. I mean, you still use your mind in sports, but I mean, it's a different aspect, right? So you can, you know, and there's a better chance for you to be successful in financial markets because it's just a matter of you going to school and educating yourself, you know, on the markets, right? If you look at sports, very few people make it to the upper echelons, right? You think about how many people make it in the NBA, how many people make it in the NFL. You know, I mean, it is like the top 0.1%. Okay, but in finance, it's a much, you know, it's a much easier route, and it's still very lucrative, from a financial perspective.
And that's what I want to talk about too, Daniel. Go ahead.
Yeah, I was just going to mention that my father had a steel business in New York City, and I saw how hard steel workers worked and so forth. But he tried to create a fund, you know, to help them have a pension, right? And then as I went into computers before I met up with Vince and we started this fund, but now a lot of people are starting with education, you know, computer backgrounds, quantitative finance, so they can go to school and they can get a finance degree or even a quantitative degree from, you know, an engineering school or something like that. Yeah. So that is another venture, you know, vehicle by which people can enter this space. Yeah. So you don't have to have just the business backgrounds. Now engineers are also getting into finance.
Computer science, economics, you know, multiple different
disciplines bleeding over.
Yes.
So now let's get down to the nuts and bolts of this thing, right? You intrigue people. Wow, I could be more lucrative, right? And you're not scheming and scamming. You know what? Let's talk about that. In the world of social media, the most beautiful thing about social media is it birthed people like me who would have never had a voice to have a voice. Right. The downside of that, it gave people who probably shouldn't have a voice.
Everybody has a voice.
Everybody got a voice, right?
Everybody has a voice. Right?
Now, how do you find out the difference between what's real and what's fake out there?
Yes.
People are tuning in. They're looking at Vince. They're looking at Daniel.
Yes.
Right?
Yes.
Threefold Hedge Fund. How do I know it's real? And then, as soon as they swipe up from this, here comes something else. How do you know the BS that's out there? Because a lot of it floating around.
It's a great question. I would say, you know, at the outset, you have to make sure you do your homework, okay? And that means doing your research on, you know, who it is you want to invest with, you know, how many people know that that investment, you know, and then basically from there, there's a number of different safeguard organizations out there like the SEC, the NFA, the CFTC. You can go online and you can look up, you know, institutions. So for example, Daniel and I with our fund, we are what's called an exempt reporting agent. And so we're on the SEC's website. Our Form D is on the SEC's website. It shows our name, it shows our address, it shows, you know, our assets, everything is on there. So we are legitimately set up with the SEC. So these are things you need to do to protect yourself, right? Make sure you're connected with people, with people and organizations that are licensed or are set up with the regulatory agencies and things of that nature.
And let me add to that, that we also have a third-party administrator. This is big because since Madoff and all of these scam people were making their own statements. And now everything is very regulated. So we have a third-party administrator. They have to check out all of our investments that it matches up. Our net asset value is confirmed by them right from the clearing firm. And then they create the statements for the partnership and they send them out to the clients. And we just check that it's right.
So you do have to watch who you get your information from, right? You need to watch who you get, you know, who you get your advice from. You know, are they in the game, so to speak, right? Or are they just talking about the game?
Yes.
I mean, that's the reality.
Oh, I like that. Say that again.
Are they in the game or are they just talking about the game?
Now, what's the difference between being in the game and talking about the game?
Look, you know, action, right? I mean, if you're in the game, you're actually really playing it, right? Like you're part of it. You're making moves in it. You are
So
affecting it, right?
If I have
you're
a Robinhood app and I download 2 shares of Apple, am I in the game?
you're in the game.
Yes.
Look,
You're
if you have
taking
one
action.
share, you're in the game. But at least you have that. If you put
Yeah.
your dollars to work in the
Yes.
markets, you're in the game,
Yes.
right? And that requires you to then do some homework on it. Why'd you pick that Apple stock, right? What price?
Yeah.
What price target are you gonna look for to get out of it, right? These are all decisions that we make,
Yes.
within our fund. So and that's those are all important pieces of the pie.
Yeah, and to add to that, a lot of people, when they start investing, they learn quickly that things like stop losses, they think a stop loss is going to help them stop their losses, but it doesn't really. And that's what institutional investors understand. And so you start learning those lessons by just having a few shares of stock, whether it's Apple or otherwise.
Okay.
But you talked about the public markets, traditional markets, and the contrast to alternatives, right? That's the world we're in. So the traditional markets are your stocks and bonds, right? And everybody's familiar with that. You buy an Apple stock, you buy Google, whatever the case may be. You're in that public market, right, where you're buying a company stock, and you're hoping that stock goes up. In the alternative space, for us with alternatives, we are a hedge fund, meaning that we hedge our position. So we don't really care which way the market goes, and that's the real benefit to what we do, right? So
Well, wait, Vince, before we get into that,
yeah,
now you get into your strategy. How do you start a hedge fund? How did Vincent,
a lot of blood, sweat, and tears, man.
5 generations removed from your great-great-grandfather coming off a slave ship to starting a hedge fund, how did you do that, Vince?
Well, first off, it starts with good partners, right? And a dream and a purpose and a goal, right? And it's been a goal of mine since I was 25 years old. I'm now almost 45 years old to be a part of to run a hedge fund, to have my own hedge fund, right? So when I was a broker, a junior broker just starting out, right? I knew I wanted to get to that level. So starting a hedge fund requires a number of different things, right? You have to, one, have an idea. What strategy are you going to deploy into the market to make money? What's your edge? Okay. Once you have that, you then test it out to see if it's viable or not, right? And we've tested our strategies in the market to see if it actually would work, right?
Wait, Vince, how much money do I need to start a hedge fund?
Look, you can start off with this. It's a slightly higher barrier to entry to start at a legitimate hedge fund. Okay, let's call it. But for anyone who wants to get to that point, like I said before, you have to get in the game. You can start with a little amount, but just prove your strategy out first, right? So Daniel and I worked together for a number of years, testing strategies, improving our strategies, and making sure we had a real working strategy to go to the market, right? And then once we got that, we then incorporated, right? And we incorporated our business, Threefold Capital Corp, which is the management company that runs Threefold Strategies Fund, and which is based out of Delaware and New Hampshire.
Why is all businesses based out of Delaware?
Because they have very favorable tax and business treatment.
Yes.
Also, when there's any issues legally, they have a good system for arbitrating.
So I'm an idiot, huh?
No, people just don't know, right?
different.
This is education. This is
Yes.
all about the education,
Yes,
right?
yes.
So you got to learn. Yes, you need to have
Every business you see, every 10Q, 10K,
It's
is
all-
all
yes.
Delaware. The
All
smallest
Delaware.
state is always in Delaware.
Yes.
And what's so favorable about Delaware?
Tax laws. It's a very, very it's a tax efficient area to do business.
Yeah.
It's good for business.
Also, if there's any contention, arbitration, somebody's unhappy with your business, their laws are favorable
for
for working those things out without a lot of expense.
okay.
Okay.
Correct.
But
I didn't mean to take a commercial break there, but I just had to.
No,
Yeah,
it's all
yeah.
good.
So
And
you
so
incorporated, you got your strategies.
we incorporated, then we went live. We went live with our strategy. So Daniel and I, and our partner, put all of our money, really, the majority of our net worth, what we had available to us in terms of cash, we put that into our strategy, right? And that's where it has stayed. And with that, once we felt that the strategy was viable, We then built the infrastructure around it. So, like Daniel was saying,
So-
fund administration, things of that nature.
Yeah, so some of the seed capital came from, at least part of it came from a family trust that I had. So, you know, there is a barrier to entry in that
Yeah.
regard,
Sure.
right?
Yeah, that's I want to
You
get
know,
those barriers.
I know,
like
I know.
this.
I know.
Yes,
Yes.
and it's good to address those.
Sure.
You know, so my father was very entrepreneurial. Like I said, my grandfather came in through Ellis Island with $5 to his name. You know, but my father, that set the stage for my father to build this steel business, and it was a successful business, but it wasn't, you know, huge. But there was a little seed money that came out of the family that then we could invest and create as the starting point for the fund, right? And once you have a little capital, just like you know from investing, we had a strategy that could trade that capital. That started producing profits. Those profits we've been investing
Reinvesting back in. Yes.
to the fund
Yes.
to create, so all the legal work, and it's expensive, right? I'm not going to sugarcoat this. We have to expend a lot to get the lawyers to do the right things and set up everything and get registered with the SEC and so forth. That takes some money. But we had a strategy, and we could produce some profits
Right.
with that seed capital.
Yeah.
So there's a barrier, but you know, on the same token, if people are saving when they're young, and I know you're big on this, Vince, so if they're saving when they're young, they can build that seed capital
Yes.
and then start something like what we're doing.
Okay.
I mean, we can get into the nitty gritty of the costs associated, legal fees, expenses.
Yeah. How much is a nest egg? You talking about I want to do a hedge fund? What's the ballpark I need to be at before I even start
Look,
talking?
you know, some of the larger funds out there. I mean, look, Ken Griffin has the largest hedge fund out there right now, Citadel. He started his hedge fund with $250,000 back when he was in college.
Was that back in like the
That was
40s?
That was
in
a
80
long
no,
time ago.
That was in 80. That was like in 88, 86 or something like that. For us,
Like
you know,
$500,000 today.
$500,000 today.
You know,
roughly.
500,000.
500 to $1 million is where you probably need to be.
Yeah.
Okay.
Yeah.
All right. So that's fair. So people know they get
Just
that
as a starting
transparency.
Yeah.
because
Yeah, I need to get to that 500 million mark.
Yeah.
Right.
Now, how lucrative is a hedge fund?
Can be very lucrative. So as it stands, when you look at the Forbes 400 list of the wealthiest people in the world, right? Most of the people at the top are in finance, and they run hedge funds.
Yeah.
So that's, I mean, billions and billions. It is the most lucrative space to be in.
Okay. So now, y'all come together. How did y'all meet?
So we met 13 years ago, roughly. You know, my background's in investments. I was in investment management and broker. So Daniel was a.
Wait, I'm going too fast here. So Vince, how did you come up in finance?
Oh, okay.
I heard your story. We talked about this in
Yeah,
Chicago,
yeah.
but I want people to see
Yeah.
your story.
Okay. So my story is about resilience and hustle.
Yeah.
Okay.
Yeah, you was hustling out there in
I
Chicago.
was. So look, I did not have a silver spoon in my mouth. I was raised in a modest upbringing in Michigan. So I went to Western Michigan University in Kalamazoo, and I initially started out, I wanted to be in marketing for some odd reason, right? I was doing a research project. I had to do a research project on a different study other than my own, and that happened to be finance. So I started researching, about finance and finance jobs and trading jobs. And the next thing I come across is these junior bond traders are making $2 to $5 million a year. I'm like, what? This is how much these people make. So I literally I changed my major that day to finance. I'm money motivated, right? I'll be honest. I had to take care of myself. So switched it up, went into finance, and then I joined the Financial Management Association in Kalamazoo. From there, we went on a trip to Chicago, and I viewed the Chicago Board of Trade, the Mercantile Exchange, and the Board Options Exchange. I saw the floor, and the energy was intoxicating, right? You saw these guys, these people on the floor, they're throwing their hands around, they're throwing papers around, and all these people are making millions of dollars. And I'm like, I need to be there. That's where I need to be. So I went to the help desk at the Merc, and I said, how do I get a job down there on the floor? And she's like, well, you got to call all the firms in the clearinghouse.
That's your question. can you even get a tour or go onto the floor still? Because I think it's closed.
It's closed now. Yeah, it doesn't even exist anymore. So that was back when it still existed.
What happened to the floor? I thought the floor in Chicago.
Well, look, the
computers?
building's still there, but it's all computers now. It's all electronic. You know, the people on the floor. No, you know, I mean, there's a few pits that are still open, but they're pretty much all gone. But
okay,
so
back at the help desk.
yeah. So anyway, so help desk. She's like, you got to call all these firms, right, and see if you can get a job. So I went back to Kalamazoo, got on the phone, and I called all. It was like 40 or 50 firms on the list, and not a single one of them gave me a job.
Wow.
So I realized later that, you know, if you're gonna be working in Chicago, you need to know somebody, right? And I didn't know anybody. So
before you can do business, you got to do relationships.
you got to do relationships. That's right. So what I did, I didn't let that stop me. Every week, I rented a car, drove from on a credit card. By the way, you know, you get these free credit cards on the campus. That's I literally like sign up for a free shirt, get a credit card. Racked up credit card debt, renting cars, driving out to Chicago with my resume and sliding my resume underneath the doors at the Board of Trade, at the Mercantile Exchange, knocking on doors, asking for an interview. Fast forward 4 months, I found this company. I found this company that I was looking to grow. I called them up, and they're like, "Hey, come on in for an interview." And so I drove again, rented my car, went out there, had the interview, pitched my life. I wore my dad's old suit, and I got the job. And I was the first one ever in that company to get a job without a license. They let me sit, take my license, and then the rest is history from there. I got in. So it's just pushing, you know.
Okay. Now, how did you come in to meet Dan?
Yeah. So you know, like I was mentioning, my father had this steel business, but I was dead set on computers. Now that was back in the time when nobody had PCs, even little PCs. You know, never mind the handheld ones or anything. But that's when I got excited about computers. I was a teenager, and went up through the engineering direction. But in 2008, I had some investment funds. You know, I had my Roth IRA and, you know, those kinds of funds, but I got a little bit more active in investing. But that was the financial crisis. And I hit the financial crisis just like everybody else, you know, and that took a really hard toll. The outcome of that was I started using my engineering skills and applying it for quantitative finance. So I started developing strategies to trade electronically in the markets. So I used my software skills. I didn't know a lot about.
Was it close to like day trading?
Yeah, similar to that.
Yes. And then I found, you know, the futures markets. They're easier to trade these futures contracts electronically. And so I started trading in the Russell and in gold and a couple of commodities and developed that strategy and got it to a point where I ended up coming across Vince, and I was a client of his because he had, you were in AGN at that time.
Yeah, I was with an algorithmic brokerage firm. I was a partner in that firm. And what we did is we specialized in finding people like Daniel who created electronic strategies, right, that they wanted to deploy into the market. And then what I would do is oversee those strategies for them and then potentially execute them, right? That was a big business for us. And so that's how we met. And so I was really interested in his strategy because this was the starting point for me thinking, okay, we could really get to, you know, I could start this hedge fund situation, right? But we have to find a strategy that's going to work. And so I would always connect with people who had a good strategy.
That's how we connected.
Yeah.
So connected. Okay. So now
that was like 2012, right?
And did you see his strategy and say, hey, we could create a hedge fund out of this?
Well, we had a couple of iterations and we got there, right? It wasn't immediate, but yes, it was a matter of like testing, retesting, and then bringing in another partner, and then we found a strategy out of that.
I think also, you were mentioning this at the beginning, we understood that we had a core ethical commonality between us. So we had a moral compass, and we understood that, and so that's how we kind of started our relationship, was really on a moral basis. And then we wanted to turn that into changing some of the more questionable hedge funds. I had tried some, you know, investments in some of these other hedge funds, but I didn't know anything about it. So like doing due diligence. how do you test that a hedge fund is good?
Right.
So I got a little bit disappointed in some of the people that I was dealing with.
So we wanted to be the good guys.
We were the good guys.
We wanted to be the
So, I
heroes.
mean, what are the bad guys? What are the bad guys doing? Tell us the bad experience.
Well, what happens? Yes.
and then that person who created that strategy, who didn't put his own money in, would say, oh well, it just didn't work. Let me try a new one, and I'll change my company name, and I'll come back in a couple of years with a new strategy.
So that was the bad side.
Those are the
bad
bad apples. Those are bad apples, and
That's
that
the
happened a
bad side.
lot. When I was over the 15 years.
So
when I was
someone will
doing
create a strategy, create a fund around it, show their past performance of
Say
the
the past
last 2-3
performance,
years.
right.
You're like, man, great. You get in there, you put your clients in there, everything's look good, markets conditions changes, the strategy blows up.
Right.
Now that the strategy's blown up, that it's like, oh,
Sorry.
Wash your hands of it,
Next.
because guess what? Their money wasn't in
right.
it, and
right.
and it's
It's
only
not-
for
it's
high.
not-
To even get into a hedge fund, invest into a hedge fund, you either got to go through an investment advisor or you got to be rich
or
anyway.
a brokerage firm, right? So
Yes.
you take people's hard-earned money, right, and then not having a sense of responsibility for it, right? So that's where we were different. And
How you different from that? What do you do?
Well, we
different?
started our fund with our own capital,
Right.
And to this day, most of the capital is ours in the fund.
Yeah.
We're now bringing in external investors, but we didn't start there. We started with our own money. We grew at 100%.
Yes.
And
5 years.
And if we're allowed to say that. Anyway, we grew our own money over 5 years,
And it did pretty well.
and it did
It
really well.
It did well.
Yes.
It
Okay.
did
Did
well.
well.
Right. And so that's when we started to go externally and raising assets,
Yes.
outside of us. I mean,
Yes.
we basically were the guinea pigs for our fund, right? We didn't have other people be guinea pigs for us. We were the ones that did it. We put our money where our mouths were. And I think if anyone goes into or is considering investing in a hedge fund, the first thing you should ask that hedge fund manager, how much of your money is in this thing?
Yes.
Because I want you to be responsible, for the success or failure of this thing, and I want to know that you're next on the line. You know what I mean? And your money's on the line. So that's what we can say.
Yes.
Okay. Now, going along, now you have your fund. Now let's get down to it.
Yep.
This mysterious strategy.
Yes, it is. Yes, it is.
The strategy that you have, y'all broke it down until we had conversations and spoke about this.
Yeah.
What is the strategy? Like, how does this work? Can you explain that to people? Because you said it earlier. You said you don't care if the market's going up. You don't care if the market's going down.
Yeah.
You don't even care if the market's going sideways, kind of. But all you care about is, when you hear that sounds crazy.
It's not, yeah. So you're like,
Make that
how's
make
that
sense,
possible,
Vince.
right? So, for the people watching, kids at home, and everything else, I'm going to throw out some terms, right? And you don't get like confused by it. Just understand that there's a basis behind it, right? So what we specialize in is something called fixed income relative value, and is in statistical arbitrage. Okay. So what's arbitrage? Basically arbitrage is you are exploiting a mispricing or an inefficiency in the marketplace, right? So something that shouldn't be there, right? You go in and take advantage of it. Now, on the relative value side, what does that mean? So we're looking, relative value meaning we are looking at two very similar instruments in the market, and we're determining the relative connection between those two instruments. So what that means is you can see two things going in the same direction, and they're what's called correlated. They're typically correlated, right? If they become uncorrelated, that's a disconnection because they shouldn't be, right? And so that's the point at which we jump in and we reduce that disconnection.
That gap becomes our profit effectively because they come back together again.
Right.
Another thing that we do is that we specialize in market making effectively, where we provide what's called liquidity, which just means that we're there to help trade, and when people want to buy or sell, we're on the other side to help provide liquidity, and that brings us, we get paid to do that. And a lot of people don't understand that, but that's another way that you can make money at the institutional level.
Yeah.
It's not really, that's not a retail investor type of trade.
Right. So I'll put it, put it this way, very simply. Like if stores selling apples for $1, and the farmer's market down the street, people are buying apples for $2, right? That's a dollar difference, right? Dollar difference. You can go in and buy those apples at the store for $1, a bunch of apples. Go to the farmer's market, set up shop, and sell those apples for $2. You have a dollar risk-free profit. That's what we do. That's the arbitrage.
That's the arbitrage.
That's the arbitrage part of it. I just want to make, because I know arbitrage is a weird term.
Let's say just compared to the public markets, right? Let's say we look at two stocks, Apple and Microsoft.
Right.
They always trailing each other. They do the same thing with each other every day. They go up, they go down. They're in the same sector. They almost look alike.
That's right.
Something happens in the market. Iran launches a missile. Blah blah. President Biden falls down again.
Right.
And market decides to, for some strange reason, these two companies are no longer correlating and going with each other no more.
Right. That's right.
They separate from each other.
Yeah.
That's right.
Then you go in and you say, hey, we're gonna
Because
sell this one.
That shouldn't happen, right?
Yep, I'm gonna short this one, then buy this one.
However, that's a really good example because that case that you're talking about is from the stock market side.
Yeah.
Where Apple could come out with some new invention, like when they came out with the iPhone,
Right.
and then that's going to create a gap between them and a company that maybe they tracked with.
That's right.
So that's much more risky. We're in the fixed income markets, and we're in, for example, we'll trade in bond funds, very high grade bond funds that track very closely with each other. Their contents is almost the same.
And the beta's pretty low.
Yeah.
The volatility is pretty.
The volatility is like
very low.
Very, very low.
Very low.
Yeah. Yes.
But sometimes, like the example you gave of something global happening in the markets, they will separate, and that's where we will get an arbitrage because we are watching them. We know exactly their net asset value.
Right.
We know what they're composed of behind the scenes. Every stock or bond, in this case, that they have. And then we know that they should come back together.
Yes.
And so in a matter of hours or days, they will come back together.
Or minutes, potentially.
Yeah, and we will capitalize on that
Right.
change, and we will have taken both sides.
Because what we're saying is it's an inefficiency, right? It's something that's not supposed to be there. So we see it, right? It's like this. We see it. We close that inefficiency. That's where we make our money, and everything goes back to normal, right? And we do that over and over and over again. Until that arbitrage is no longer there.
And you use the bond market because of its size.
The size. It's a very large and liquid market. Yes.
And you like to use it because I'm guessing because its beta is low. It's not like wacky tech. It's pretty. The bond market's
That's right.
pretty.
The volatility
is
is very low.
very
It's
low.
pretty low.
Yeah.
Yes.
Yeah.
Yes.
Yes.
Okay. Now, how did you discover the strategy?
So there are a number of larger funds out there that do something very similar to us. Okay, our Daniel and I and our other partner who's a part of this as well. We were all working together, effectively at this trading firm, and it's it's a proprietary strategy, right? So there's prop traders in the industry, and our partner is a professional prop trader. I was sitting at the desk as well, trading algorithmic strategies, and Daniel was working with us. So this is something that came out of a number of academic studies. A number of larger funds do this. So it's something we knew of and effectively, started to trade and run and test and prove the validity of it. And that's where it came from.
Yeah.
You know,
Capitalize
it.
on it. And
Okay.
once we knew it could work, you know, we put our money into it and to see if it, you know, to make it work
Yeah.
in real time. So
yeah.
yeah.
And it's
I think that's a
evolved
very- yeah,
over
it's a very
time
short
as
time.
well.
Right.
So we started more heavily with the arbitrage, but that had a little bit more risk. But we're talking about, you know, low compared to what people, when they invest in the stock market, like Apple and Microsoft. But it was a lower risk, but it still had some risk. And we've evolved to include treasuries, short duration treasuries. Treasuries are just when the U.S. government, you know, puts out, puts out debt,
T-bills,
T-bills.
exactly.
Yeah, exactly. And the shorter duration makes them less volatile even more because they're just like cash.
Yeah.
We're basically bringing, you know, premium to cash.
Yes.
Now, what is the downside? How could this be like worst case scenario? Like, oh my God, market conditions change, something happened.
So yeah.
What is so that you can foresee
Right.
that black swan that you could, if you could see the black swan, what would it be?
So with anything, there's risk, right? But you know,
What is that
The,
risk?
the reason why we chose this strategy is because the risks are extremely low for us, and that's what we're looking for, right? Our goal is principal preservation, right, and capital growth. So, you know, the one thing where there is potential risk for us is, you know, if we get into a trade where the two instruments have diverged from each other, right? And that divergence stays a little bit longer than expected, potentially, right? So there's a little bit, instead of closing out where we think it should close out within a matter of minutes, or whatever the time frame may be, it stays open a little bit longer and we're exposed.
And that's hurting you because on the top end, when you're shorting, you know,
Right,
you could be, it could get called away.
It could go. Well, if you short the overbought, right, that short goes up, goes against you. You know, that's a potential loss, right? And if you're buying the oversold, then and that market sells off, right, from there, then you're exposed too. So it's just a matter of timing for us. Really, timing in this strategy is our biggest risk, but we manage our book so that we can effectively reduce that exposure, right? Reduce that risk a little bit, you know, from that standpoint. But yeah, it's all about timing, more or less.
Yeah, and we have carrying costs. So, you know, we have our investment capital, but we also do some leverage off of that capital.
Yeah.
So there's carrying costs. So if things do not converge or they diverge more,
Yes.
that would be a risk, right? But we have a defined amount that can go.
Now, people like you here, like Warren Buffett, right?
Yes.
What he said about hedge funds. Oh, they're the worst thing in the world. They got 220 rule.
Yeah.
They're going to make their management fee regardless, whatever. What do you have to say to that?
Again, so we put our own money at risk, and you know, we take the fees, you know, that the fund charges along with it. I think that, you know, when you look at a hedge fund in a large scale, and what Buffett's usually saying, it's like some of these hedge funds, their game is just to raise assets, raise the assets and get the management fee, right?
Yeah.
Our management fee, we reduced that. One thing, I'm not, you know, we reduced our management fee because we were just focused on the incentive. We want to be aligned with our investors. So, you know, we have to make money for our investors every single month, you know, and new net highs is what it's called, or watermark, in order for us to get our incentive. So that means that, you know, our interests are aligned, right? If you know, our clients don't make money, we don't make money, effectively. That's how it's set
So
up.
y'all not on a 220?
So I'll tell you, it's a 1 in 20.
It's a 1 in
what
20.
we do. So we reduced our management fee slightly, and that's at the advice of our attorneys, because they say you have to do something to keep the lights on, right? People want to know that you're going to be around for a while. But
Yeah,
we
that
need to
was
lower
an
it.
advice from the attorney.
So is the hedge fund, is it good for the people that are in the hedge fund, or is it good for clients as well? Because some people are like, oh yeah, the manager, they good, they're doing great, but nobody else does great.
Right.
That's the
So
Bernie
we-
Madoffs
yeah,
of the
that's good,
world.
yeah.
So we produce, you know, we can't talk about our numbers in public.
Come
but
on, give us a number, Dan. Hiding out the numbers.
He wants to.
But
Trust me, he wants to.
I want to, but we do better than the S&P 500. I can say we beat our you know, I think we can say that, right? I don't know if that's.
Well,
Well, look. You know,
We do very well.
Yeah,
But
go ahead.
Here's the point. Here's the point. In terms of answering your
and
question,
so, and for my audience to know, why are you hesitant about the returns?
Oh, it's because from a regulatory perspective.
Regulatory.
Right? We can't. There are rules, regulatory rules that state you can't publicly, promote your hedge funds. So what you can do is educate people, right?
Yes.
Talk about the overarching strategy, but you can't really go into like the details of.
We get this much, and we did this much,
Right,
and we did
right.
this
So,
much.
but I have an idea for how to explain and answer
Okay.
your question.
Go ahead.
So we publish for people who we can, hand the returns to, because we can publish a fact sheet. It's called a fact sheet. And everybody we know or come in contact with, we can give a fact sheet to. And that fact sheet has our fees already removed, right? That's the 1 in 20 that we're talking about is already out.
So this is just pure return.
Pure return,
return.
of what the investor is going to see.
tell people-
And I have a copy
That's
for
what
you
we show.
as well.
You got a copy?
This is it right here. So,
So you're welcome to review it.
But you can see it right there.
definitely
That's for
will.
Prince.
Yes.
So
Yes.
so
That's
here's the
my
thing.
gift to you.
Thank you. So, because I always tell people don't care about management fees if they're making money,
Exactly.
right? If I gave you $10,000 and you brought me back $20,000, and you said, "Hey, I took $5,000 from a," well, okay, I gave you 10, you brought me back 20.
Still double my money.
That sounds like good business, right?
Right.
So, but yeah, so that's always kind of been, but
we do
that's
well
really
for our
pushing,
investors.
Yes.
So we are very committed to that. That's again goes back to our having our money in the fund ourselves.
Do well. Yeah.
We're doing well for ourselves. In fact, our investors have done better in a certain sense because the only capital that we've extracted, we've put back in to try to travel and meet people and do
We're building a
marketing.
business. We're running,
Yeah.
running a business. Yeah.
Now, speaking of growing a business, right? So people at home, we may not understand it, maybe on the retail side. When you look at a fund, you got to raise money.
Mm-hmm.
You got a strategy. Man, I have to get people. I got a good spaghetti sauce, but I got to get people to come in and taste
Right.
my spaghetti, right?
Right.
How's it been raising funds,
It's been a challenge because
especially being black and brown?
yes, it's been a
Yeah.
challenge
Gotta
for
go
us.
that route.
Absolutely. And I'll start, and then
And
Vince can.
then tell me, why has it been a challenge?
Yeah.
So it's been a challenge because people are educated to, bring their money to Schwab and Fidelity and, Goldman Sachs and so forth, Morgan Stanley, and just track the normal traditional markets. And when it comes to alternative investments, there's huge amounts of fear. And partly because of some things we've already talked about, that there have been bad actors out there. However, the regulation has caught up with a lot of that bad actor activity. And so now you have a lot in place, like third-party administrators who take care of the accounting, and you can get audited.
So you're not allowed to have your own accounting no more.
That's right.
Yeah,
you
no.
do it
No, you do it
externally.
Externally.
Yes.
When I have a third-party
yes.
person doing it.
And,
That's right.
and they
What
are
about the actual deploying the strategy? How do you deploy the strategy? Are you at home sitting at a computer? Do you have a third party? How do you put all that together in
Right.
business?
So we have service partners, right? So like our prime broker, the clearing firm. So we execute everything through those institutions that are regulated on themselves. They safeguard assets, So these are all things that are kind of table stakes, right, to have a hedge fund. But for us, so just to kind of jump on Daniel's point of raising assets, being black and brown, we're a minority-based hedge fund, right? Minority-owned hedge fund, and mission-driven as well. But we're not known, right? We're not the known entity out there, right? We are an emerging manager that is out there trying to make a good return, which we have. We make a good return, but we're just not known yet. So that's the biggest thing, right? When you're an emerging manager, it's like getting known, getting the awareness built up, and we're doing that as we do things like this. Come on the Prince Dykes Show, right?
Yeah.
We're raising our awareness, right? So those are things you have to do constantly. You have to have a plan.
yeah.
2020 was a good year.
Yes.
Yes, it was.
You saw that.
And 2020,
Yeah.
that time in March, was not a good year for a lot of people, right? The
Yes.
traditional markets,
2020,
they
that
didn't
was
do
COVID.
very well. That was COVID.
That was
Yeah.
COVID.
But we
But you see, we do even better when there's high volatility because those separations that we were talking about increase because of fear and greed, right? The standard principles, the human involvement in the markets. We're there,
that's what
and we're and we help smooth out the market as a result of that as well.
Now, somebody who's watching this, they see this, and they say, well, you know what, that's great. I never even thought about this. How much money do I need to get involved? How can I get involved?
How can you get involved? Well, you can get involved in a couple different ways. One, if you are a private investor, individual investor, and have $250,000, right? You can invest with us directly, okay? Or
And what is your minimum?
so our stated minimum right now is $250,000. That's our stated minimum. But we have the ability to, reduce that rate, if need be. If I think
that
down
capital.
down to $100,000 at the lowest point. But $250,000 is our stated minimum. Another way that you can do it is, say for example, if you run a registered investment advisory practice, and you invest your money into that registered investment advisory practice, and then that RIA, right, goes in and invests on your behalf with us. Because typically the RIA will have, accumulated assets, right?
Yes.
And then you can
you
be a
don't
part of
need-
it, from that perspective.
Because that's clearly a big hurdle for many people. And
Accessibility.
yeah, yeah.
Like, hey, I got $25,000 in a Roth or whatever. I can do it.
Yes.
Or 250,000.
Right.
And what's the steps on that? Some
Right.
people look at that, they'll be wondering like, hey, what do I got to go?
What do I have to do?
The RA, So I think the accessibility,
Yes.
right, that we spoke about earlier.
Yeah.
So registered investment advisory firms,
Yes.
are another accessible point, to get into a hedge fund, because you have an independent RIA, and that RIA looks at the hedge fund and says, oh, these guys have a good return. I know these guys, they're solid. Let's go ahead and put some money. Let's go ahead and put a couple percentage points of our money into this, and get a return for our clients.
Yeah.
Okay. So now going forward, right, what is the ultimate dream? 1 billion, 2 billion?
Well,
I'm aspirational like that.
we have
I know
I like where you go. I like where you're going.
Yeah. We have goals to we take net 12% of our net capital, net income. We reinvest. We put into the community. We donate to nonprofits that are community oriented. And I think we might have mentioned that at one point. But clearly, the larger you grow a fund such as ours, the more that 12%, 12% grows, right? 12% of net profit from a hedge fund. We want that to go back into community-oriented nonprofits.
Right. Look, I think J.D. Rockefeller said this, right? He wanted to make as much money as he possibly could to give away as much money as he possibly could, right?
Yeah.
And that's basically where that's what we are looking to do, right? So, you threw the B number out there.
Throw $1 billion?
Because
Okay.
you know what? Because we are able to, as we do it, we can give back more.
Why is it those hurdles? Like, everybody, hey, fundraising this stuff is hard, things like that. Why do you see, black and brown face so many, the barrier to entry is so high?
Yeah. So there's a looming, there's a 800-pound elephant in the room, if you want to call it, right? It's the wealth gap, right? The wealth gap in America, and that wealth gap, in some instances is getting wider and wider. Some stats for you. There's 22 million millionaires in America right now, right? Out of the 22 million millionaires, less than 6% are black, right? There are, what's the number? There's like close to 2,900 or so, just under 3,000 billionaires, right, in the world, and there's only 16 of them are black. Wealth creation and generational wealth creation is something that has eluded, a black community for a long time, right? We haven't been able to access, and so, what I want to do and what Daniel wants to do is we give back to community organizations is educate, people of color of our nationality, our descent, our culture, help them get more acclimated, help them get used to, help them get access, right, to these markets that'll help bridge that or close that wealth gap in America.
The other thing is that if you look at the firms in New York City, traditionally there's been a lot of, the father is in the firm and his son, and so you've built up a certain culture there.
Yeah.
And so we're connected with a nonprofit in Chicago called Skillfully, and they actually specialize in trying to help do placement of interns and young graduates,
New faces.
into a bit of an insular community in New York City, in particular, but it's in any city.
They're just helping get
the
black and
finance
brown
in
kids into finance, because they normally wouldn't look at finance as an area of focus, right? It could be something else. So this is another way to help, that we're helping with that.
Why do you think the wealth gap is there and continue to grow? Why do you think that is?
Well, because lack of ownership. Owning your company, owning your own businesses. We just don't do. There's a lack of that. Education, right? Just around financial markets and financial literacy as a whole. So what you're doing is great in terms of building financial literacy for people and kids. And then it's just a generational thing here, right? When you look back to our history, slavery was a real thing, and we couldn't own things for a very long time. It's just now starting to change, but throughout that time frame, we just haven't been in the ownership position. So we had, it's a generational thing that we just need to overcome through education and through ownership. We need to own more.
So there's a cultural gap in people learning early in life about finance and investment. Some of the outreach that you're doing is, key to that. So I think there could be a pretty rapid shift if people started embracing the idea of investment as a way to build wealth, and particularly then intergenerational, which is another educational step. So it's not just making money for yourself, but actually then intergenerational.
Right, or being a steward and stewarding stewardship and stewarding that wealth
now,
around generations.
This is one of the things I look at too. Now, could you look at, because you're so far behind, right? People are getting richer and richer and richer. They're on their second, third, fourth, fifth house, business, whatever, franchise, sports team, I don't know, whatever it is. Whereas hey, you're so far behind, you're renting, right? So you don't own a primary you don't own a primary residence, so you're not making money, right? So I've seen it myself in my line of work where you go in and parents are, just because of where they come from and who their parents are, I can talk to them blue in the face. Even I can try to give them stocks, but if the parents is not in tune enough to go do it for them, they can't even get it, right? So in the financial industry in America seems to be more lineage based. If you are born into it, good for you. Dad gives you a bank account and a savings account and makes you spend 1/3 of your money doing this and 2/3 of your money doing this and investing in all the good stuff, good for you. But if you're born on the other side of the tracks, what are you being taught? What are you going to learn? Right?
Well, look, I broke that. I broke that mold. With, my family didn't come, wasn't in the finance world. We didn't talk about it, talk about finances. It just wasn't a part of my upbringing growing up. But I was able to. I transitioned and got into finance because of awareness, because I was made aware of the possibilities. And it was through school, going to college, and educated on it, right? And being interested in it as well, right? I was really interested. I wanted to be a part of it, and so I would go out and seek, information wherever possible. And I think now in the age of technology, everybody has access to some form of access to social media. Yeah, just checking in, connecting with, these industry titans and people who are doing it and have been doing it for a very long time is a good way to just build up your awareness of what's possible and what's out there. I think that's what's helped me out.
I think for me, my father having the steel business, so when I was a teenager, I was traveling with him into the Bronx where he'd have his factory. I saw that he was building equity, right? Whereas the people he was hiring, I mean, he was good to his employees, right? But they're not going to build the equity. And once you start understanding that difference between being an employee and getting an hourly wage, right, versus building equity in a company that's growing, that's a game changer.
And
I was going to just jump in real quick. There's a great quote. It's like, you can't be what you can't see, right? And it's like, it's just literally Daniel's talking about how he saw it.
Yes,
the
he saw-
sector,
yeah,
right?
yeah,
I'm telling you now,
I can see
I
it.
could,
Yeah.
I saw it. I
Yeah.
saw it. I read a book about it. I was doing
Yeah.
research on it. I did a project, and I'm like, this is the world. You know what I mean? So
Yes.
it's getting access. Is you got to see
Yeah,
it.
visibility.
what's the likelihood of a strategy? Like Threefold, right? You see so many strategies come out of, y'all you're in Boston. That's like the hedge fund capital of the world, right? You got strategy. How you know what strategy? Threefold, same market 5 years from now, 10 years from now.
Well, the markets are always shifting, and that has to do with government. For example, over the last 10 years, there's been huge amounts of what's called money supply, or money additions. And everybody knows this because the government is putting trillions of dollars of money during COVID and so forth into the money supply. So that creates inflation, which we're all suffering from right now. But that changes markets. So we've seen an evolution in markets. So you have to start understanding what creates these cycles. And so I have a slide that I put together for a presentation that shows the bull and bear markets, basically when the market's going up and when the market's going down. And if you look at it, it looks like a wave, because you can always expect there's going to be something, whether it's COVID-19, whether it's
Some black swan
financial
gonna come
crisis.
down.
There's always gonna be
something's going to happen. And so when you start understanding the dynamics of what makes those waves, then you can start applying, a mathematical approach or a quantitative approach to trading, and then you can make a profit off.
Another good thing to think about in keeping it really simple, right? Is, look, you find the right people. You find people. You find smart people to work with. Okay, and like I said at the top, top of the interview, it's like we look for smart people. You look for the right. You look and see if they're registered and everything else. If they're good, they'll help you put together the right portfolio. Right? Getting with a smart person who knows their stuff is also a point of reference. There are basic strategies out there that you can deploy into the market that will give you a balanced portfolio. Right? You have a mixture of stocks, bonds, and now in this case, I believe you need to add alternative investments to it, hedge funds like us, because what we'll do is smooth out your risk, right? Because we do well in volatility, right? We'll offset that downside risk on when the S&P takes a drop. So it's find that balance, right? Stocks, bonds, alternatives, hedge funds, you need to have all of them, right? Because when you have that full mixture, right? The markets go any way they want, and you may not always win, but you won't lose as much either. You know what I mean? In some cases, so you want to offset that risk.
Yeah.
That make sense?
Make perfect sense. Hey, get a couple different alternative investments. Don't just kind of get locked into on one thing. Add this to your plate.
Right.
Hey,
right.
this could bring down the volatility.
Right. Exactly.
Right. Hey, you got some leverage stuff in here, blah blah.
Yeah.
We can have this in here, bring out, help out with the volatility.
We're all part of this ecosystem, right? And what we're trying to do is create balanced portfolios for our investors and clients so they can do well over time. So we're not saying get rid of stocks and bonds. We're saying we're a part of it.
Yeah, part of
you know
it,
what I mean? And a percentage of it.
I think most people, when you look at that barrier of entry and that accessibility, right? Like if I was online and I saw, hey, this is Threefold Strategies. That sounds pretty good. I like Vincent Dane. I want to get into it. How can I do it? Right? You got to go through this and that to invest into hedge funds.
Well, it starts with a conversation. It starts with reaching out to us, right? So yes, we have our website. You can go on our website, and you can fill out a form, a little form, and we'll give you a call. We'll talk to you, and that's the first step, right? Just connecting with us, and we'll talk, and we'll walk you
What if
through.
somebody's uncapitalized? I got 50,000. I don't have the 250,000. What do you tell them?
I tell them to call you.
Like what? Better call
No,
Chris.
but look,
But
look,
really
no, I'm
with-
being that's you're not being funny about
RIA.
it because you
Because
have the RIA, right?
Yeah.
You have the RIA. They put 50,000 with you. You can do something. You can start to create that balanced portfolio where a portion of their assets are in stocks, a portion of their assets in bonds, and a portion of their assets are in Threefold, right? But because you're going in with a larger pool of money, right?
Yeah.
And
We're
you're
trying to
dispersing.
build up more connections, or you could say feeder RIAs that
Yeah.
can pool assets, work with their clients.
It's just like a stock being on the New York Stock Exchange.
Yeah,
Yeah.
And if I'm listed here, the more people, the more
That's right.
accessible I can make it to an RIA,
That's right.
the better. Right?
Yeah.
That's right. And
Yeah.
you know, and I know that if we're working with you, you're mission driven, we're mission driven, minority owned, and we're looking out for our communities, right? So we're
Right.
we're doing well, for people, and we're doing good for ourselves.
And
And
got a soft spot.
yeah, exactly, right?
Okay.
Yeah.
Looking out for everybody.
Now, when you look at your returns, right? You're looking at a hedge fund, coming out, starting a hedge fund, being a minority hedge fund. I got to go back to this. We talked about this earlier, that barrier of entry, right? Not the barrier of entry, but fundraising.
Yes.
Right?
Yeah.
What can be done to be fix that?
Well,
Try to raise money.
so where we met, right? This is where at the Investment Diversity Advisory Council, right? IDAC. There are organizations out there that support the growth of minority-owned hedge funds and minority and gender-based hedge funds out there, right? So I think that's a good starting point, just to work with those organizations that are set out to support growth and raising awareness for minority-owned businesses.
Dane, do you think it's this way, that companies, whereas in, let's say, companies feel like we already got it, we're good, we don't need anybody? Do you, or do you think that's a real thing in business in general, right? So let's say, hey,
Yeah.
you're a minority. Let's say, hey, you say, hey, my dad got off the granddad, got come in through what's it, Perez
Ellis
Island?
Island. Ellis Island, New York
Perez.
City.
He coming through Ellis Island, right?
Yes.
And he's signing his papers and stuff
Yes.
like that.
Yeah.
And America needs a lot. It needs a lot. It needs infrastructure, it needs telecommunication, financial system. So it's a bunch of opportunities. Do you think that now people are like, hey, why would I? Everything you could think of is already done. I don't need you. We already got a bank. We already got a hedge fund. We already got this. We got that strategy. I have that. I'm at the top of the hill. Why do you think minorities? Do you think that's the issue that minorities face when they go out into business? That hey, we're good. Like your family have a trust. We already have a this.
Yes.
Why would we open up the door and take a risk on this?
Yeah, I know it's a very real question, and it hits all different aspects because, for example, nonprofits, boards of nonprofits, they usually have some kind of endowment. The board members of nonprofits are not generally finance investment people. They might be a nonprofit for teaching or something. And they may not know how to invest. So they will stick with these very traditional investments. The reality, though, is that the Citadels and the larger hedge funds, the Jane Streets, all of these are capitalizing effectively on the trading that's going on with all of these teachers' pensions and these more retail investors. And they're extracting that capital for their own benefit, but some of that capital could be going back into those communities. And if people were more aware of how to invest, just like owning your own business, you can gain in that equity, right? Versus being an employee, it's a similar thing in the markets. So people could also take advantage by going more into alternatives. Alternatives is more of an institutional level investing. There's just more money to be extracted from the markets. And that goes back into the community.
Yeah, I would.
And that goes to, what the root of that is when you ask that question, financial literacy.
That's right.
Financial literacy.
People
right.
don't know
Yes.
Yeah.
what they don't know.
That's right.
They don't
Yes.
know.
They don't know what
Hey,
they don't know.
I'm just
Right.
bargaining.
Yeah.
I'm shopping for the cheapest price.
Right.
I'm getting the cheapest price. I don't know that these returns
Right.
Yeah.
Right.
are hurting me
Right.
or could be potentially helping me.
Right.
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 Well, honest, I'm bargain hopping, saying, hey, for a prime example, you could say, hey, you know what? I'm looking to get this notebook made, to make a proposal, things like that, right? You
Yeah.
can say, hey, I can go buy from this company, or I can buy from this company, because if I support this company, then this is going to happen, right? And I think that's a real conversation that people really don't know they need to have, is that people is nothing against you. It's just, I don't need you.
Yeah.
I'm good to go, right? You take somebody like Warren Buffett, Berkshire Hathaway, I don't know, I think they reported on their last 10Q, $200 billion in
Right.
cash,
Right.
Yeah.
right?
Yeah.
And I can
Right.
put it right into a T-bill
Yeah.
and get the safest 5%. What's 5% of 200 billion?
Yeah. A lot of money.
A lot
Right?
of money.
I'm making billions just
Yeah.
Just sitting there.
government bonds,
sitting there, yeah.
right? And guess what? I have everything that I need, everything that I want. Here comes this random dude knocking on my door. Here comes Vincent. Hey, I have a strategy. Why would I want to give you an opportunity? Because sometimes I'm already fixed on McDonald's. I got everything we need,
Yeah.
right?
Right. So our clients are not the Warren Buffetts.
Yeah.
Right.
Who's
or
your ideal client, I would say?
Our ideal client is somebody who understands a little bit about investing and wants to get an institutional level product, but it's a growing, emerging manager, because they're not going to get access to these
the bigger
other
firm, yeah, the big-
funds.
So because the other hedge funds y'all were telling me about. What
Yeah, they're
Ken
going to have
Griffin-
they're going to have $1 million.
The minimum to get into their
minimum.
fund is $100 million to get into some of these larger firms.
Yeah.
You can't touch them. Sovereign
Yeah.
wealth funds go into them. Large pensions go into them. So
Let me
we are
guess,
making.
They're saying, hey, we don't need you because we're just taking our own returns and sticking with the same people.
And they have their own
yeah.
team of investors. So, if you look at Harvard and Yale and even Baylor,
The endowments, yeah.
the endowments of these universities, they've collected so much money in tuition that they've got these large endowments, and they're their own hedge funds. I mean, these are billions and billions of dollars that they've got, and they have their own teams. They hire them in, quants and so forth, and they trade.
What is the percentage of most hedge funds to be successful?
1%.
1%, right?
Yeah.
So someone could like, man, that's extremely risky.
Yeah.
Yes.
Yeah.
If I go into a hedge fund, that's going to be extremely risky. When I can do a CD, something more conservative. What do you have to say to that?
Well, I'll put it this way: there are large. I want to say the number, but there's a lot of hedge funds in the space now, right? That smaller number that I mentioned before that are successful, right? It still creates a nice marketplace for people who want to go into the hedge fund space and find a top quality, high performing fund, right? So there's opportunities there, okay? Yes, by and large, there's a lot of hedge funds that don't do well or fail. But look, what you're looking for is a premium, okay? When you go into the hedge fund space, you're looking for something that is uncorrelated, and it's not going to be easy,
When you say correlated, if something's uncorrelated, can you break that down?
Yeah, so something that's uncorrelated means that it will perform well regardless of what happens in the stock market. And that's how our strategy is set
Correlated
up.
to the market.
Yes, correct, to the stock market, right? So that's what you want. And there's a small group out there that do really well, and we're one of them. And so you just have to do your homework and find those.
Yeah, let me
top
add to it
quality ones.
that having a 5-year track record is a minimum, really. You want to have that track record because even though past performance doesn't predict the future, that's the standard line that you have to throw out there. It's true, but on the other hand, the longer the history you have, the more you can rely on at least some dynamics and some statistics that you can look at. So it's important, part of that education that you're talking about is to understand some basic statistics. Like what is a drawdown? And a drawdown is different from a 1-month loss, but it's the total, the lowest
trough.
point, the trough point, where you could have a series of monthly losses that builds up. That's the drawdown. But understanding that, and understanding the highest gain, the highest period of gain, and being able to even just divide the highest gain in its history by the drawdown, that's called a profit factor. That gives you an indication right there. Right there.
That's
a lot of people don't even know how to do that.
Right. How much risk am I taking for the return I get?
Yes.
Okay.
Yes.
That's what he's talking about.
Yes.
So, for example, the S&P 500 over the last 20 years has returned about a 10%. It does about 10% return, right? 10% return over the last 20 years. But the risk, all right, the risk on the other side of that is 16%. Okay, so you're risking 16% to make 10%. So you're risking more than you make. Now, for us, you make more than you're risking, right? Yeah. That's how our profit ratio is set, without going into numbers, and by a large margin. Okay?
Right, but that ratio for the S&P 500 is 0.5. It's less than 1 on S&P 500. The numbers you just gave, because the potential gain versus
the risk you're taking.
Versus the risk you're taking. So that's a really important number to just understand that one number.
I wanted you to speak to two people, right? So let's say I'm some crazy kid who sat here and watched Prince Dykes for a whole hour, talk to hedge fund managers, right? And he has intrigued me. Vince, hearing your story. Daniel, hearing your story. I want to get into that industry. What would you tell them?
Well, the first step
I have a story to tell.
is to look at the educational side. If they want to get into this industry, first of all, getting into
I'm not Ivy League. I'm not an Ivy League.
Right.
I'm just a dude, decent intelligence.
Mm-hmm. Yeah.
What would you tell them?
Maybe you'd like to take that.
Look, I can tell you from living it, right? I was that person. I'm not an Ivy League guy. The first thing you have to do, depending on the age. Now, if he's getting ready to go to college, take some math classes, take some finance classes, right? Check them out, and get involved.
I'm bagging groceries right now.
Yeah, if you're younger than that, or you're in high school still. Look, a lot of schools now have business focused programs in the schools, right, where they can teach you little basics around financial literacy and finance. Look, your community organization right now, in terms of your financial literacy, check in, and there's ways to get started in better understanding the basics first. You got to get the basics down, and then you can kind of continue to progress and move up the ladder. But I think a basic understanding of financial literacy, whether it be through your organization or if there's a school organization, that's a good way to get started. And then you continue to go from there and build.
Yeah, and I would add to that STEM, maths and sciences, are also more and more important for the financial markets because they're becoming more financially and algorithmic based.
Now, what would be your ideal candidate as a hedge fund manager? You're like, you know what? I like him or her.
I'll let you, because your interest is different than mine on this one, but you go ahead and start first.
Okay. So somebody who, for me, thinks mathematically and algorithmically, people who maybe like to play cards. My son is a professional poker player.
Wow.
And that takes a tremendous amount of mental math and arithmetic, that you're doing while you're sitting there at the table. And and ultimately, there's an algorithmic approach that can happen. Poker has effectively been solved algorithmically. You can run an algorithm that will show you the best hand for every, the best action for every single hand. What happens on the river and so forth, right? So people who are able to think on their feet and play cards, that's certainly, the kind of person. People who can look at what's called the macro picture, dynamics like you were talking about of something happening in the world and how that might affect the stock market or the bond market, right? Understand the difference of what's going to affect a bond versus a stock because they're affected differently. and people who are curious about the world, and they want to understand those dynamics and how they work together. So it's a puzzle that you're kind of trying to solve.
Okay.
So on my end, I would say someone who is used to dealing with people, right? And they can connect. They have a personality. They can build relationships, because this is a relationship business, right?
Can you say that again, please? Say it 10 times for me, please. I tell people that all the time. People, all business is business. Like business, the root of business is relationships.
It is.
Relationship. People ask me all the time, Prince, where did you come from? How did you do this?
Right.
It's the root of it is relationships.
That's it.
Yeah.
That's it.
Right? You got to build relationships in order to do anything. But go ahead, Vince.
No, that's the core of it for me. You know, like having someone who is not afraid to work and hustle, can build relationships, you know, make friends. You know, if there's a question that they have in their, if there's a question or a problem, they can look to their network and solve it, or find someone that can help them solve it. Right? I talked to a school, a high school class a couple of years ago, and I said, look at the person to your left, look at the person to your right. You know, that's your network. I go, if there's something you want to do in life, there's somewhere where you want to go, you could ask any of these people in your classroom, right? Like maybe their parents are involved in something that you're interested in, or maybe, you know, they have a friend or another family member that you could connect into, but you don't know that unless you talk to them. So you got to talk to everybody, and that's what I've done. I talk to everybody.
You just
right?
never know.
You know, and that's I
That's a really good point.
I make connections. You know, you got to be able to make connections.
Yeah.
Yeah, you know, like I was saying, I was telling Tim Cullen, who y'all met, CEO of Colorado Harvest Company, my projection is that I say marijuana will probably be legalized on the federal level in about 5 to 10 years. And my projection is his company will sell probably for about $50 million.
Yeah.
Once it's legalized, I think private equity is going to come eat it alive. I think they're going to eat that whole industry alive. You know, that's ripe for them. They notice the industry's there, people use the product.
Right.
If you're
Get in early.
profitable,
Yes.
you're already making money.
Yep.
Who's
Yes.
not going to come eat you alive?
That's
and
right.
then take you and combine y'all together,
Yep.
and then make one big company.
Yes.
He's already growing. Doing I say, hey, you know, I could just,
Yeah.
you know,
Yeah.
that's just you're waiting on regulations, and that's what's going to end up happening.
Have you studied the principle of stewardship, where you keep a company private, don't bring it public, where it then is at the whim of external investors, but you keep it private? It's called stewardship, and it's an idea that's growing, you know, both in Europe and the U.S.
Why? What's the benefit of being?
Because then you protect yourself from just being eaten up by these VC firms.
Yeah.
Because once you go public,
Anybody can. You're
yeah,
free
then
game.
you can have you know,
Somebody just buy a bunch of
somebody
your
can
shares
buy the shares up, etc. Yes,
and end up on your board.
exactly.
That's what y'all made the Cookies Famous Amos.
Mm-hmm.
Yeah,
That's what happened
That's
to
what I
him.
did. That's right.
Yes, you know,
That's right.
he's been on the show as well. But get to know him, that's
Yes.
pretty much explain what happened to him.
Yeah.
But he said back then in the 70s, he didn't know what equity was. And
Exactly.
He was just trying to raise money.
Right,
Right.
exactly.
He didn't know he was
Right.
raising money. The next
Yes.
thing you know,
You're giving away
this
shares.
person brought the shares. They brought the
Right.
shares.
Yes.
The next thing you have a board meeting, and here I am.
And then
You're like, who is this guy?
And then somebody has a controlling interest, which means they have more than 50% of the shares, or they've pooled because
Right.
they have different entities that have bought up shares, and then they work together and they form a controlling interest.
And they've
And
Or-
then they can take over control, and then you're done.
Or let me guess, a private company could stay private. A private equity firm could come in and maybe,
Yeah.
you know, take an interest and then maybe sell you to another private equity firm and stay in the private world.
They could.
Well,
they-
if
they
you
could do
stay
that.
in the private world, if you protect yourself by not being over leveraged, by having too much debt, then you can just stay private and nobody can touch you.
And actually is the beauty of Tim's business, right? He talked about that, right?
Yes.
He's like,
Because he can't have debt.
Yeah.
He can't have debt.
Yeah,
Right.
He can't borrow money.
No, you can't. You
Right.
can't
So,
right
I'm
now
like,
you
you're
can't borrow money, but
profitable
he
and
never
you
did.
can't borrow money?
Right. Right.
Right.
That's why I was like, dude, you're gonna get, you know, it's just a matter of time.
Yeah.
Right now they're not touching you because, you know,
Yeah.
it's legal in Colorado,
Yeah.
but that
Right.
business can't be touched because, you know, federal
There's
money.
there's a tremendous opportunity in that business,
It's-
and I'll tell you, you're absolutely right. There will be private equity firms or hedge funds that will be knocking on his door at some point, right?
Exactly.
When it becomes federally legal, and the doors are open, and you can do banking with it and everything else, and they'll go in and make him an offer, right? And they'll buy, potentially buy him out. He can take it or not, right? But that's going to be for an owner. That will be his exit. That's his liquidity event, and that's your.
Right.
So that's
right.
That's
right. But the alternative is the stewardship idea, which is to bring it, just keep it in a trust, and then make it available to the community, because otherwise you can have other forces that just try to capitalize.
Oh, that's Dave. If you don't mind me asking, how old are you?
60.
60 years old. What would you tell the 39-year-old Daniel?
I would tell him, build your own business younger, because now I'm building a business later in life, and I've been part of other companies. I've done well as an engineer.
That's what I'm Dave, but I know you're pretty financially good.
Yes.
Why not just go be rich?
Because my goal is to give back, and the actual name of our fund, Threefold, comes from a philosophical idea. If I could talk about that?
Please do.
Okay.
So we'll talk about that,
Okay,
please.
so it has principle of 3 areas. The cultural has to do with the individual. So it has to do with education and the arts, everything that affects individuals, but out of creativity and out of their own talents, right? Then the political has to do with equal rights, black-brown rights, everybody's rights, and across the board. But that's called the political domain, and then the third is the economic. And the ideal for the economic is that it is not just capitalism for capitalism's sake, where you just get your piece and you keep it, but it's not socialism or communism either. There should be some element of brotherhood, where you're thinking about who the consumer and the producer are, right? So like even when we're talking about you're an RIA, we're a fund, and you might have clients, right? Those are relationships. You were just talking about relationships, and building on those. Then that becomes what's called producer and consumer, but that's out of you have an element of brotherhood, that you care about the consumer, the person who's maybe investing in this case, and you're, as a producer, you're a fund manager, you care in the reverse to give back to the community. But also then you take some of your profits and you actually bring it back to that cultural domain, the arts, education, and you enable things like private education that is not accessible now to inner city kids, but maybe you can make it accessible to them, right? So that they have an alternative to the public school system. They might have a private school system that they can also take advantage of, if enough money could flow in that direction.
Now, when you look at your business, so let's go back to the original question. You would tell the younger Daniel to start a business earlier.
Yes. Yes.
So you think you'd have got more enjoyment out of it, of life, by having a business earlier?
I would have been able to give back earlier. It's more about what I could have done.
Change the world.
Because like you're saying, I did well enough in engineering that my needs have been taken care of for a long time, my family needs, right? But if I could have built a business earlier, then I could have had capital to give back to the community earlier in life. And that would have been fulfilling for me. I'm trying to do it now, and that's why we're doing this fund.
You are doing it now.
Yes, I'm doing it now.
Because how much?
We're doing it.
Because y'all at what, 11?
11 and a half, yeah, 11 and a half.
11.5 million?
Yeah.
You getting up there?
Yeah,
we're getting there.
We're getting there.
We're getting there.
Vince, same question for you. How old are you now, if you don't mind me asking?
I'm 44.
You're 44. What would you tell the 24-year-old Vince?
I would tell the 24-year-old Vince to keep doing what you're doing, but be intentional about what you're doing, and don't worry about moving so fast all the time. I'm an aggressive guy as it is. I was a very aggressive kid, and when I was 24 years old, I knew where I was going, what I was doing. I was going to get this hedge fund going. I was a broker and everything else, and my career path trajectory just went like this, straight up, right? From commodities broker to currency trader to director at a major brokerage firm at 26. I moved up the ladder. I was became global head of $150 billion banking line when I was 39 years old, right? So these are all I move fast, but at points in time in my career, I moved a little too fast and maybe with less intention, and I was slightly too aggressive. I think I could have calmed it down just a little bit, and really been a little more tightly focused, and not just a rapid pace aggressive guy.
Now, Vince, you mentioned this earlier before starting your own hedge fund, that you was a partner at another firm.
Yes.
If you don't mind me asking, what was your salary?
Yeah. So, man, every point in my life, right? I was 20. I'm gonna say, going back to when I was 24 years old, roughly. At 24 years old, I was already making over $125,000 a year.
At 24.
At 24.
So that probably was back in the 90s, early 2000s.
So that was what was that? 2000. Yeah, 2004. 2004.
And the reason I'm asking this, I want to show people a partner at a firm with their comps.
Right.
What their salary will probably be.
So so you start to get up there, right? And it goes from where I was at starting out and getting to that first level where I was making over $100,000 a year at 24 years old. It progressed steadily from there. So 125 to 250, 250 goes to 320, 320 goes to $500,000, $500,000 goes to over $1 million.
So you can tell me, as an employee, you're making over $1 million a year.
That's correct.
This is what I want people to hear, right? Because you don't hear this, because people always think that, hey, I get this much an hour, $40 an hour, $10 an hour, $20 an hour. So you're making $1 million a year.
When I was an employee, yeah.
As an employee, right? You should say that louder. I want people. I know you like. I want people looking. But this is why I do this, right? Because I want people to see that. Hey, I don't want to say, hey, I have to go play for the Denver Nuggets.
Right.
Yeah.
Right?
Yeah.
In order to be successful.
Yeah.
There are people in the industry who have 7-figure salaries.
Yes. Yeah.
And they're an employee. Right?
100% in this industry, yes. Yep.
So let me ask you this question, Vince. Same question I proposed to Daniel. So here you are, making 7 figures, right? Relatively young man. Why not just keep doing what you're doing and just be rich and live your life?
Well, one piece of it is exactly what Daniel said, which is I want to give back, right? And you can by leveraging capital, you can give back more, right? You can by building a business, you can move higher. You can build more to give back more. That's one piece of it. The other piece for me is I'm never satisfied, to be honest with you. And I'm telling this to kids, just to be real, right? You should never be satisfied. There's always a bigger push. There's always more to do. There's always, in my opinion, that's just how I'm wired, right? Like, so, if I hit a certain level, I congratulate myself, but then I say, okay, what's the next step? Because I don't want to become complacent. I don't want to become complacent, right? But I know the more I do, the more I make, the better off everyone around me will be, because I want to give back.
And the thing I look at it too is, with me, what drives me the most is, I look at mortality, right? One day we're all gonna leave this earth. I wonder what is supposed to be my spot. Am I really living at my full potential?
Right.
Who wants to be that basketball player that really could be in the Hall of Fame?
Right. But then doesn't go for it.
They're playing pickup games at the local YMCA, and they can do all the dunks and the moves, but they're just really not putting that. You're like, well, I wonder how far can I take it?
That is exactly.
That's right.
That's a better way of saying what I just said.
Exactly.
No, yeah, like that's
Like, is this
exactly
it?
right. Right.
Do I have a little bit more, or is this my
Right.
peak?
Yeah. Right.
You know.
Right.
So, but you never know. So you're like, I'm gonna try a little bit more.
Are you living up to your potential?
Right.
It's like
And if-
stretching.
That's right.
It's like you're doing a stretch. You're like, oh, okay, I did that. I'm
Yep.
just not gonna
Yeah.
stretch a little bit.
You
You
can
know.
stretch a little bit more.
And just like Vince was mentioning, I think in his career path, I got to the highest level of engineering, right? Which is you have to decide if you're going to go the management route after you become a architect. So I got to the software architect level, but then you have to just either be a CTO, which is much more kind of like almost a management level. There's a technical aspect to CTO, but you're bordering on that management side. So that's part of that decision. And so then if you want to go beyond, you want to form your own company.
Okay. So before we get out of here, what would be your advice to me, Daniel? For what you know me, what would be your advice?
Your advice in terms of your investments or?
No,
That's
advice-
life
life
and
advice.
life, just
Life
life.
advice.
Oh, okay.
Because I think if I get the life advice, I can figure everything else
That's
out.
right.
Oh, okay. Well, I think people have to follow their dreams and understand their talents. And out of their talents, they can figure out the pathway to how they can contribute back to society. So, my advice is to, for people to look at, gain mentorship, find mentors, and people in this room are mentors. All three of us, in some capacity, are here trying to mentor other people. But then through that, explore their talents to the highest degree possible. And it can be very much successful through, being an employee, or it could take the form of either being an investor, saving your money and investing and learning how to invest, or being a business owner.
Okay. Vince, what do you have to say?
My advice to you is, look, make sure you're focused on your targets, right? Whatever it is that you are trying to accomplish with everything you do, because you're doing a lot, right? Focus on, what that goal is, what you set. Make sure you don't lose sight of it. Make sure you're doing everything you do should be moving you towards that, achieving that goal, right? I think some people will set goals for themselves and then they'll maybe lose sight of it. They're still successful and they veer off in different paths. I would just say, like, you have a dynamic framework here. You have tons of energy. You are you're doing a lot of great things, right? What are you shooting for? What are you shooting for? And are you doing everything, every single day you wake up, are you doing everything you can to continue to move towards that target, right? Hyper focus.
Yep.
That's
I like that. Good. Mentorship, hyper focus.
mm-hmm.
All right. Is there anything you want to leave to the audience or the people out here listening today?
Look, education, right? Education's key. Financial literacy, I think, is key. For those who haven't been exposed, you have to get exposed. You have to have awareness. You have to be interested, right? So get involved, get in the game, right? It's like that is like I said, don't talk about it, be about it, right? If you want to be in finance, connect with people who are already in it, right? And people that you're here, you're watching the show, right? Connect with Prince. I know they can send you a message, right? Mm-hmm. Connect with me. I'll talk to anybody, right? Mm-hmm. We can help you. I think just being open to connecting with people, not being afraid, going after what you want. That's kind of my takeaway from this whole thing, and what I would like to give to people in the audience. Because the sky's the limit.
Yeah, and I would just add that, with that education component, educating yourself not just about, some particular career path, but also always remembering that you got to educate yourself about finance, because that's an important aspect of how you take care of your family and your community ultimately. Mm-hmm. And so, then reaching out like we're both talking about with mentorship, to people who have come before you and have learned the ropes and are looking to give back. So those are the components that I would look for is, again, coming out of people's talents, how can they connect with people who can help them develop those talents?
Yeah. Well, I
And
went on my time.
look, and you have that fact sheet. So
Yes.
we're Threefold Strategies Fund,
Okay.
and we are emerging, we're growing, and so if there's any interest there, reach out to Prince, give me a call.
Yeah.
We're happy to talk to you.
Yeah.
All right. Threefold Strategies. Daniel, Vince, it was awesome and great.
Thank you.
Thank you.
Ladies and gentlemen, until the next video, podcast, cartoon, book, or whatever else crazy you see me do around the globe, just like Vince said, I need to be hyper-focused. Peace, be safe, I'm out, and thank you. Thank you, guys.
Thank you.
Thank you. Thank you.